there are over 2,800 companies that are below $300 million market cap. And it's the least efficient place, as you would expect, since there's not a lot of liquidity. You don't see a lot of institutions or professionals playing in that area. So it's a large universe where very few people look at. And for me, I'm the portfolio manager of a microcap fund. I have one analyst. We do this full time, but it's still a lot of opportunities to look at for just two people. So what we try to do is get to a no as soon as possible. When we look at something new, we try to reject it right away and make sure we spend our time wisely on the right opportunities. So I just share the top 5 reasons why I pass quickly on something. So the first one was, a lack of profitability. There are so many unprofitable companies in microcaps. Companies are so early stage, so it's normal. Like I don't expect it any other way. But for me, I think if you find a company that has at least a couple quarters of profitability under their belt, it reduces the risk a lot. Because it shows that the company can stand on its own. The second thing was I'm looking for revenue growth. If you're a microcap company, especially below 100 million in market cap, there's no way you get discovered by the institutions and you get better liquidity, multiple expansion, analyst coverage, all those good things if you don't grow. So for me, I'm looking for companies that can grow at least 20% a year. Like the example I gave, like if you're a $15 million revenue company growing 5% a year, like you're gonna stay a microcap. I'm sorry, but it's gonna be very, very challenging to go beyond 100 million in market cap. Then you have the balance sheet. Anything that has a weak balance sheet, lots of debt or negative working capital, I typically don't touch that because usually they're gonna have to raise capital, and it means more dilution. It's a lack of focus also for management. The fourth thing was a bad management team. So sometimes it's hard to tell because most CEOs are good salespeople, or at least if they're dishonest, they're probably good salespeople to hide that. So you got to be careful. But some hints for me are how much they seem to focus on the short term versus long term. So if they always talk about what they're going to do next quarter instead of over the next 2-3 years, if they seem promotional, they talk a lot about the stock price. They always say that they're so undervalued and that they're going to do more IR, more promotion, things like that. Those are all red flags to me. And then every time I look at a new company, I also Google the CEO's name and see what comes up. Do they have a shady past or something? It doesn't happen a lot. I don't often find something, but you never know. And the last thing was anything that's commodity related. So I have no expertise predicting macro cycles or predicting the price of gold or any other metals. So I avoid those sectors altogether, and also anything that is what I consider a commoditized product or service, where there are no barriers to entry, no product differentiation in the marketplace. Those companies tend to be, commodity-like businesses. They're price takers. They don't have any pricing power. So I try to avoid that as well. And if you look at these 5 criteria, you probably remove over 90% of the microcap market in Canada. So that's a very efficient way to filter and get to the investable companies, in my opinion.